Okay, let's move on to discuss private mortgage insurance. Private mortgage insurance, or PMI, is insurance that protects lenders from a loss if a borrower stops making mortgage payments. In most cases, the borrower pays the premiums for PMI. PMI is typically offered on conforming loans where the mortgage insurance premiums, or MIP, deal with FHA loans. Some of the factors private mortgage companies consider when they set their rates and coverage parameters include the loan amount and type, the LTV, and the borrower's credit score, as well as the type of property. No one can predict future circumstances. Defaults occur. Without PMI, the lender could be subject to considerable financial losses. To limit the risk, PMI is required for all conforming loans with less than 20% down payment. Let's take a look at the benefits for the borrower. PMI has many benefits for borrowers. With PMI, a borrower can buy a home with a smaller down payment, for example, 5% or 10% of the home's value. PMI companies have worked with many lenders to develop programs to help borrowers with lower income and insufficient savings. Its programs use flexible qualification requirements and allow a borrower to devote a greater percentage of the total income to the mortgage payment. Let's talk about the termination of PMI. Under HPA, which is the Homeowners Protection Act of 1998, borrowers have the right to request cancellation of PMI when they pay down their mortgage to the point that it equals 80% of the original purchase price or appraised value of the home at the time the loan was obtained. However, borrowers also need a good payment history, meaning that they have not been 30 days late with their mortgage payment within a year of the request or 60 days late within the 2 years. Their lender may require evidence that the value of the property has not declined below its original value and that the property does not have a second mortgage, such as a home equity loan. Under HPA, mortgage lenders or servicers must automatically cancel PMI coverage on most loans, once the mortgage is paid down to 78% of the value if the loan is current. The HPA establishes 3 different times when a lender or servicer must notify a consumer of his or her rights. Those times are at loan closing, annually, and upon cancellation or termination of PMI. Finally, we will discuss types of private mortgage insurance premiums, focusing on the monthly premium. The monthly premium plan is the most widely used option and requires just 1 month of mortgage insurance premium at closing. Monthly premiums substantially reduces the total closing costs and makes getting into a home more affordable for the borrower. Mortgage insurance companies have different rate factors based on the borrower's credit and loan profile. Here is an example of a typical borrower and the calculations involved to determine the monthly premium. The homeowner has a down payment of 5%. His mortgage is $150,000. His credit score is 690, and his profile dictates that he is priced as follows. Step 1. Determine the factor from the mortgage insurance company. The annual premium factor for this profile is 0.94% for the loan terms greater than 20 years. Step 2. The annual premium factor is multiplied by the mortgage amount, which is $150,000 times 0.94%, which equals a $1,410 annual premium. Step 3. The annual premium is divided by 12 to get the monthly amount. In this example, it is 1,410 divided by 12. This equals to an amount of $117.50.